Even in an AI-focused world, MacroEdge is in the business of focusing on you. We don't just understand our clients, we listen to what's said and illuminate on what's not. In a world moving at the speed of light, with shifting markets, evolving workforces, and non-stop disruption, MacroEdge helps you to navigate and identify novel opportunities, expand your enterprise, and succeed in tomorrow's world. And it all starts with you. Put your enterprise and your perspective in the driver's seat. We're in the business of you.
And good evening, everyone. Welcome to MacroEdge Radio number 65. Tonight, a very special show with a former BlackRock trader, something that most of you would never imagine John Galt would be involved or interviewing. However, this is a unique perspective as Ed Dowd, one of the most brilliant prognosticators, speakers about tech, the COVIDian experience, and the macro picture we've entered into, including this AI data center bubble, which we'll get into in great detail, is joining us tonight. Hopefully, our friends at X and Elon Musk cooperate so we can actually conduct this interview. We're going to be bringing him up in a minute. I'll leave this quick, short, and sweet. Stocks rebounded today. They didn't close at the highs. I told everyone who's paid attention, who's paid attention that this is Peterborough Friday at noon. All the traders leave. Ed can verify that for us. But enough of John Galt blathering. Mr. Dowd, welcome to MacroEdge Radio.
Thanks for having me on today. I hope to have fun today because we're living in absurd times.
I 1,000% agree. If we're going to use the president's parlance of, oh wow, 1,500% price reductions, let's have 1,500% more fun. Why not? The reality that you just said is more than people can understand, where the absurdity is stretched beyond just our financial system to the culture, to society as a whole. And there are major implications for that. But let's get the market discussion out of the way first, because everyone likes to hear what your take is on this. And I'm just going to let you rip with that, because I have a funny feeling it's not too dissimilar to many of our listeners and many of the staff at MacroEdge.
Yeah, I mean, basically, we've been watching the coalescence of a bubble, the internals of the market getting weaker and weaker, breadth narrowing, and the headline indices being led by 7 to 10 stocks, while the rest of the economy is in free fall. And this is classic. We saw this in the 99-2000 bubble, and we saw it going into 07. I was a growth stock portfolio manager, and we were long all the darling stocks, kind of knowing it was a momentum game and that bad things were coming. And the day we flipped was the day our P&L flipped. And basically, we were something like 800 basis points ahead of our benchmark going into the top in October. And the moment, one day we came in and all the darlings sold off, and we owned them all, and we were down 250 basis points to our bench in one day. We hammered and just we turned tail that day, and we got underweight those stocks. And it was just we knew we were playing a momentum game, and when the momentum shifts, you got to get out. And we knew from my experience as a former bond salesman at HSBC that the housing stuff was getting serious, and our bond guys at BlackRock had been screaming bloody murder for like 5 months. And we knew we were late in the game. We knew equities were the last to the party. So, I suspect the AI bubble is already in the process of it's already peaked and it's rolling over, and momentum players are turning tail because they know the game.
Do you view the AI bubble, because you were trading in 07, I was in a totally different field. I was in logistics and housing and dealing with what happened on the ground. So I saw it from a similar perspective, except there weren't tens of billions of dollars at stake. But do you feel the AI bubble is not dissimilar to the quote unquote blockchain bubble, which was going on at the same time when the housing crash occurred?
Yeah, look, it's so opaque. We don't know what's going on. And I think Michael Burry has pointed out that OpenAI is at the center of it, this dark hole of deal making. And when this blows up, we're going to see a lot of hidden debt, a lot of SPVs. Looks like private credit's been financing a lot of this, private equity, and we'll see what the fallout is. But it's already starting. The bond market through the CDS market and whatnot is already kind of telling you that financing is getting tighter. Sam Altman told you that 2 weeks ago or a week ago when he basically asked for a bailout at the top. The most ridiculous thing I've ever seen in my life. I mean, there's not even a crisis yet, and he's already asking for goodies and handouts. So they've all signaled that it's rolling over. And this last quarter that we saw from NVIDIA, I knew that they were going to paint the picture as best they could, and they did, and the market sold off. The market sold off and NVIDIA sold off. They sweated the balance sheet. Cash flow from operations peaked last year, and its cash flow efficiency is going the wrong way. So this is classic.
We've had quite a few guests talking about NVIDIA, CoreWeave, the entire on-deck shuffle of circular financing. But is it not dissimilar, in your opinion, to what we witnessed in the housing boom, where you had hedge funds, banks, et cetera, financing each other's debt, hedging against each other's debt? You were on the front lines for that. It's the same circular financing pattern, except the majority of it this time is in a dark pool off public record, not as visible. And despite what certain journalists on a network that starts with the letter B said, is potentially putting some banks at risk for lending to the non-financial banking institutions.
Yeah, there's going to be some blowback for sure, and we're not going to see it until we see it. It's much like when I was at BlackRock, we knew things were getting dicey, and there was a lot of cross financing going on, and all you had to do as a risk manager was understand that it was the risks were not apparent to everyone and that it was going to get really bad. And so you just step to the sidelines. And by the time the headlines come out and people know what happens, the damage is done. So you just have to know that there's hidden risks. This is Ponzi finance at its best. And it looks like it's peaked to me. I mean, I could be wrong. I mean, the administration has one more ability to goose these stocks, and that would be to come in and say they're going to take a big equity stake in everybody. That would be the final pop, and you could fade that and be rest assured you're getting out. If you're long, get out, and if you're more speculative, you could short the hell out of those things.
But which is what I was looking at from a bigger perspective. Everybody wanted to short Goldman Sachs in August of 2007, and the Fed essentially bailed them out by cutting discount window rates and providing quote unquote inside information, allegedly, so they could take advantage of the situation and start bailing out of some of their bad mortgage paper. I don't disagree with you. I think we're going to see something similar, but not till after the fact and after it's occurred. Is it not true, despite all of this pomp and circumstance and promotion of quote unquote retail has figured it out, they're ahead of the pros, et cetera, that the utter nonsense we're hearing in that thing is to simply pump up the confidence of retail to buy the garbage on the front end, so the larger banks and institutions can bail out and leave the regional community banks and, of course, the bag holders of retail sucking wind, for lack of a better term.
Absolutely, and there's going to be a regional bank consolidation when it's all said and done. There's going to be a lot of banks that are going to be shotgun marriage to J.P. Morgan, Bank of America, the other big ones. That's definitely we're going to have fewer banks at the end of this. Absolutely. And power and money will consolidate. And retail is always going to be the bag holder. I mean, retail going into this top was the participation was the likes of which we hadn't seen in a while. And I was interviewed by Adam Taggart, and he was asking me about that move in Oracle. It was about a month ago, 2 months ago, 30% in the aftermarkets when they announced. They had a horrible quarter, but the stock went up 30% in the aftermarkets because of OpenAI deals being announced. And I said to Adam, these are ending moves. These are not beginning moves. These are ending moves. And I think one of you guys today pointed out that Oracle is basically almost flat on the year after that the credit market started to say no mas. And that's really what people in the equity world need to understand. The credit people are starting to sharpen their pencils, and they're starting to get a little nervous. and that's how it begins. It just pauses the financing, and then it feeds on itself. And Sam Altman told you all you needed to know when he and his CFO Sarah Fryer, who I knew in another lifetime as a Goldman Sachs tech analyst on the sell side, basically was floating the idea of getting help from the government to finance these data centers.
I think the government is going to intervene at some point for selected data centers, but the reality is, and no one has answered this question, you're technologically adept at answering this. I have to admit, I'm a total geek, so this is a geek out program for myself. When you look at the data centers and you see how many are already in service in the United States, you have to ask the question, why are we building more and introducing capacity that by the time the power supply to these centers is in place, the centers are open, the racks are filled, the technology that's in them is going to be 2 or 3 generations old before they flip the switch. It's not a logical build out from any perspective other than to sit there and promote and pump stocks.
Absolutely. This is a CapEx cycle, luring in retail on the dream and the hype. I mean, look, AI is real. It's gonna be a thing, just like the internet was a thing, just like the railroads were a thing. But there's overbuilding, overhype, and these people are while they're hyping this cycle, and they got to keep the CapEx flowing and the NVIDIA chips flowing to show that there's actual demand where there really isn't a lot of end demand for open AI in terms of profits. They need to, and that's to keep it up and floated so they can dump their stock. This is classic pump and dump by the insiders into a hype cycle. That's going to crash.
I was bringing this up earlier to someone, and tell me if this does not sound logical from your perspective and from many who are the smart money, especially credit, which if you're not paying attention, boys and girls, that's called the smart money for a reason. You look at what's occurring with the data center build out or alleged build out in the United States, and then you look at what our number one competitor in the AI field, which is China, for lack of any other discussion, it's a fact. China is not having this massive build out. They're building out power locations to generate electricity to sit there and power their society, but they're not building specific generators on a mass scale like we are to support the AI industry. I know that AI is being attacked from 2 different perspectives, but from the American perspective, we're still under this antiquated concept of bigger is better. It's like we're trying to sit there and force elephants into a phone booth and saying we're improving the phone booth.
You know, from what I understand, DeepSeek came out earlier this year and was able to do it at much lower compute costs. And, you know, of course, the AI bulls were telling me that it's Chinese propaganda. So if you look at what you just said, if they're not building out the power, wouldn't that to support the incremental AI build out, then something about what DeepSeek is doing could be potentially be true, and if it is, the whole economic model that we have is garbage for AI. That is more power, more chips, more data centers.
That would seem that leaves only one viable logical customer for all of these data centers, and it's the same one who built a gigantic data center in Utah, and that's the U.S. government. And if they're going to be the buyer of last resort, that should be somewhat terrifying to the American public. Would you not agree?
Absolutely. And look, there's a lot of people who contend out in alternative analysis land that they're building an AI digital grid to corral the population as we go into a financial reset. So that's one theory that people are positing right now. That, and you know, Larry Ellison's quite open about it. He says, you know, citizens will behave better if they're monitored 24/7. I mean, he says it outright. He's not hiding it.
That is a fascinating aspect of it. We'll get into that later in the show because I think you're right. They're not hiding what they're going to do. They're telling us what they're going to do. And the so-called transition to a central bank digital currency is nothing more than the digitization of the United States dollars. We're already there at 90% levels. You very rarely see anybody using cash. So this idea that we're not going to have a digital dollar, that horse left the barn a long time ago. Let's go back into markets real quick, though. I want to outside of this, The bond market seems to be sending mixed signals right now. And I'm concerned about this because I think people are misreading the idea that yields are going to rise much faster than we anticipate. If there's any hint that we're paralleling some of the behavior of '07, where we may well be, if not already, are in a recession, especially since we're masking the data by claiming everything can't be collected due to a shutdown, does it not raise suspicions that we will see a bond rally on the pretense that QE could return with a vengeance, especially once Powell's replaced?
Yeah, so we put out an economic report for our clients in the beginning of January, and we said, as we roll through the year, you want to lighten up on risk assets and get long cash and cash equivalents. And if you're more, you have more risk tolerance, get into the 10 and 30 year because they're going to rally quite a bit. And I know when we said that in January, that was a very contrarian trade. It's becoming less contrarian, but there's still a lot of negative sentiment. People think that yields are going to go up. They're not going to go up if we go into a recession, which we're predicting. The housing market is rolling over as we speak. That's 20% of the economy, and there's no way to avoid that. It's just what's going on with affordability and the inventory that we built out, especially in multifamily housing. We did a lot of that in multifamily housing construction in the last 4 years. We're at levels not seen since the 70s. It's in some of our real estate reports. And the crux of this crisis will be multifamily. That'll drag down single family homes. And of course, the cessation of the illegal aliens at the beginning of the year really took away what was an underlying bid to rents, which support home prices. So that's all going the wrong way. And we have a nice chart in one of our reports that shows homes for sale versus homes sold. The gap, it's a gap we haven't seen ever. The time series usually tracks pretty closely, and the gap is going to close, and it's going to close with prices coming down. Eventually, people are going to figure this out, and once prices, and they're already starting to roll, they'll accelerate. And as the consumer economy, which is already rolling. You look at consumer stocks. Anecdotally, small businesses are dying. I live on Maui. People are struggling. Restaurants are closing left and right. The Joe Six Pack is tapped out, and those little tiny cash flows roll up into all the other big cash flows, and they start to cause credit issues. And we've already seen that in was it Tricolor Auto, the prime lender to the illegals, First Brands, which is an aftermarket auto parts shop, and then Primalend, and that's kind of the canary in the coal mine. The average Joe six pack is tapped out. Those tiny cash flows add up to big cash flows, and that's why credit's having a problem. The credit markets are starting to realize we're screeching towards a recession. I believe we're already in one. It'll come out later. I'm a cynical person, and when I saw they weren't going to release the October data, I was like, you got to be kidding me. If you go back to the Reagan shutdown in the 80s, that was 35 days was the longest. We beat that, I think, finally this time around. They were able to produce a jobs report with less computer systems than we have now. So, there's something weird going on. I'm just super suspicious of what's happening right now.
Well, it's nice to meet someone as cynical, if not more cynical than myself, to be quite honest, because it reflects in the idea that we suddenly can't collect data, but we're able to produce an unemployment report for September and revise August to negative 4,000, but we suddenly created 119 in September. Maybe I'm a cynic, maybe I'm a skeptic, maybe I like to call BS when I see it, but I find the disparity in the data since the August termination of the head of the BLS. Granted, I've been a longtime critic of the BLS and their methodology, but I find the disparity in the information we're getting and the reality that you and I and others see on the ground and report anecdotally and with accurate measurements somewhat disturbing. It's almost as if we decided to propagandize our data from the government for the purposes of supporting equities and bond markets with no structural reason to do so. It's just not there in the foundation.
That's why I think one of the biggest asymmetric trades is, the 10 and 30-year U.S. government bonds, because once the truth comes out and there's this awakening to where we are in the economic cycle. It's going to happen fast, and these things are going to reprice quick. And most people aren't positioned for that. Most people, after a multi-year bear bond market, are underweight fixed income and overweight equities, and that's going to hurt a lot of people. It's going to be pretty ugly.
Well, that's going to be a bloodbath. And I really think that after we get through the holiday season, and I've already stated that there's a good possibility we'll see a two handle on the 10. I 110% agree with you. I think we're going to put some panic support into the markets under the false belief that that will support housing, when in reality, it's an affordability issue. And as I discussed with Michael Ferris, and welcome to listening to our show, Mike, we really need a bout of deflation to correct the problems and errors that have occurred. But in your opinion, do you not feel that the idea or concept of controlled deflation is about as insane as the concept of controlled inflation?
Yeah, it's an escalator up, elevator down. There's no way they can contain all the feedback loops once they get going, and that's why the system is always so afraid of deflation, because it's always faster on the downside than it is inflation on the upside. It just is, and credit destruction is going to start happening fast. All this, the M2 that you saw that's been created was mostly Ponzi credit. There's a mistaken belief the Fed's been printing money the last year. That M2 that went up was Ponzi finance credit, and we're starting to see anecdotally, marks go from 100 cents 3 weeks prior to zero. And Gunlach, the new bond king, basically said this is a joke, and it is a joke, and it's trillions of dollars worth of a joke.
The consequences of which I don't think Americans are prepared for, and I know you feel the same way, listening and watching and reading your works. When you look at what's happening, what would you say to the guesses? I'm saying 75 to 80% of the American public is positioned on the wrong side of this trade, which historically would be the norm heading into every great reset, not a financial reset, boys and girls, but a reset of market conditions, be it in the early 1900s, the 1920s, et cetera, through the 70s, 80s, et cetera. If people are on the wrong side of this reset, is not our demographic structure even at greater risk moving forward? Because there's going to be not just panic selling, there's going to be another period where people refuse to invest in the markets from getting burned so bad.
Yeah, that could definitely be the case. Our demographics are not good. There was a reason they attempted to bring 20 million people into the country in 4 years super fast. It was to stave off a demographic decline. With the cessation of the illegal alien inflow, Goldman Sachs put out a chart earlier this year that we potentially could be minus 500 K to the total population for the first time in like decades, like an actual negative number. Now, our demographics, while bad, are not as bad as Europe's or China's or Japan's. The demographic picture globally is bad, which obviously should get people thinking deflation, not inflation, and that's what the money masters have been trying to prevent, is the deflation of financial assets, which eventually happens when Joe Sixpack can't spend anymore. And I think we're right on the edge of that in the U.S. We just put out a China report that's quite pricey for institutions that basically says China is going to enter its acute phase of its real estate crisis starting. It's already started. It's going to be accelerating into 2026. So they are also in a deflationary panic from their own internal economy, and their answer to that is to export more and depreciate the yuan more.
Do you feel that China, this is a great time to bring this up because you brought that up yourself and introduced it in the conversation, but do you not feel that China, because their financing is pretty much self-contained to its own banks, they could monetize a lot of their own losses, but at the same time export the deflationary impulse to the rest of the world? Because reality is the Americans, the Europeans, South Americans, doesn't matter what country, can't compete on scale with their production capabilities.
Correct. And they hit a demographic wall in 2020. And I'll just give you a little tidbit from our report. They basically hit it in 2020, and it's accelerating into 2032. They're going to go from prime age workers of about not, and when I say prime age, that's when you're the most productive in the economy and spending. It's 16 to 64. They have a population of 900 million of those folks going to 750 million by 2032. It's 1% decline a year. It's devastating. So their internal consumption is plummeting. That's why when you look at the price of oil, that's mostly China. And that's why they have all this excess industrial capacity. And that's why their exports since 2020 have ramped up quite a bit. That's been really what's been fueling their GDP growth. As low as it's around 5%. That's really what's been kicking it into gear, and we're going to see more and more trade wars, more and more dumping. This is not a pretty picture. So deflation is coming. The inflation bugaboo that everyone is in the still talks about is in the rearview mirror, and it's coming hard and fast. And we're going to see unprecedented, things from the Fed and fiscal stimulus once we start to see asset markets really tumble, and we'll see what the response from the Fed is and from the fiscal side, and then we'll have to determine whether it's enough, and it's going to start another reinflation period, or it's just going to be a dead cat bounce and then more pain. We'll figure that out, all of us together, as we roll through time. We're in the beginning stages of this, where they can't start printing now because they needed an excuse, but that's coming.
Well, when people say they can't start printing now, I look at it from the perspective they can print, but only to the idea of buying from those key banks, institutions, and industries that they have to pick the winners and losers. This is a great subject to switch to. I've been ranting like a madman into the darkness about the corporatist model that the Trump administration has suddenly adopted, and for some reason it doesn't seem to catch on. But it's a reality that while the quote unquote government capitalist model that China has is what we're trying to copy, we're really copying something darker from the 1930s. And that scares the hell out of me, because as things deteriorate further and faster, it would seem logical to take greater control of the economy and also blow bigger bubbles in the end.
That's certainly a problem, and I'm kind of, look, like you, I'm horrified watching all these investments in Intel and what I suspect will be investments in the AI complex. As a free market person and watching this, I'm just horrified, and it's this is picking winners and losers, and the Trump MAGA people who don't ever question what he does. Just imagine Kamala Harris doing the same thing, but with her own private, pet projects. So this is just dangerous precedent, in my humble opinion.
It's sadly enough, he sounded like FDR this afternoon in some regards, in some of his commentary. And for those who don't pay attention to history, who are joining us tonight, FDR was a huge fan of Benito Mussolini, massive fanboy. And Benito Mussolini's leading economic advisor, Alfredo Rocco, promoted the idea of a corporatist state cooperation where they picked the winners and losers and got rid of the competition for those companies. That seems to be what we did in 2007 with the financial institutions, saying these 10, 5, whatever, they get to stay around forever. When you talked about a consolidation, I've seen some stories and some hints that we could see fewer than 1,000 banks in the U.S. by the end of this decade. Does that sound like a viable outcome?
I think it's when you say viable, I think it could be one of a potential outcome for sure. And I remember when the government bailed out Wall Street. People said, "Oh, Wall Street took over the government." No. The government took over Wall Street and proceeded to hold them up for basically bribes. Obama did not prosecute any bank. Not one banker went to jail for any of the mortgage fraud, if you remember. And there was this too big to fail issue that Eric Holder said that's why they can't go after them. Well, what the banks did is they paid all these huge fines out of earnings over the next 5, 7, 8 years. And those fines went into these government consumer funds, which found their way into leftist NGOs. That was one of the biggest untold stories of it was basically a gun to the head of a lot of these executives, and they paid the piper in terms of fines, but no one went to jail.
And everyone got their bonus and got to collect on their options.
Everyone was happy. The bonus, I mean, there were a lot of seats. It's musical chairs on Wall Street. So after the great financial crisis, a lot of people lost their seats and never made it back in. But those who stayed in their seats had a pretty good gig, basically in bed with the government at the top executive levels, making a bonanza every year.
Well, Ed, take a moment, promote your Substack, promote any other media you wish to do so. We always invite our guests to do that. And I'll take a quick plug for MacroEdge. MacroEdge.net/ozone, MacroEdge.net/ozone. Sign up, get a 2-week free trial, see the data options, see our new dashboard. You will enjoy it because we provide the alternative perspective, looking at other ways to measure data that brings more information to the investor. Sir, please promote your website and everything else that you wish to do, because you're a fantastic author, you're a great speaker, and some of your videos have been alerting to the unawakened masses if they actually pay attention to listen to what you say.
Yeah, so I wrote a book, Cause Unknown, The Epidemic of Sudden Death in 21, 22, and 23. That's on Amazon. My firm with my partners is called Phinance Technologies with a PH. It's phinancetechnologies.com, where we have all our free Humanity Project vaccine research, and we also sell economic research if you're interested. I also have a personal website, eddowd.com.
Fantastic. Thank you for that. And folks, follow Ed, listen to his interviews, watch what he says, and pay attention. If you say you haven't learned anything from him, you weren't listening. That's why we wanted him on our little humble spaces. We try to sit there and bring every perspective that we can. We touch on real estate. We've touched on the data centers. We've touched on the AI bubble, sort of. Give me your take on this. I viewed the top of the AI bubble when Target reported their disastrous earnings the other day, and the CEO led off with, "Oh, and we've partnered with OpenAI to help improve our systems and profitability." When you have companies that are not profitable being hired on to sit there and advise on profitability, I usually view that as a top. Do you see this black hole finally starting to contract and close, where people are seeing through this and saying, this is nonsense because I've used their tools, I've analyzed their LLMs, it doesn't seem to be productive enough to offset the upfront cost?
Yeah, in the current iteration of AI, the savings aren't there. It's going to improve over time, just like the internet improved over time, and there will be an adoption curve. And out of this AI blow up, out of the rubble, some gems will emerge. There's some companies we probably don't know about that you'll want to look at down the road. My guess is when this blows up, there's going to be niche AI companies that focus on very vertical sectors of knowledge where they'll bring down the hallucination rate, and there'll be a lot of niche AI companies in different silos. That's kind of where I think it might go. But let's back up. Has the bubble peaked? When I saw Oracle do what it did, and its stock price went up 30%, that was kind of it for me. And then we started hearing about all these deals being announced where there wasn't even any power. So the gating factor used to be NVIDIA chips. Now it's power. So NVIDIA is going to run into a problem. No one wants to buy chips 3 years before you need them. So NVIDIA is going to hit a wall. It's just a matter of time. The whole thing's going to hit a wall. And the CDS market is telling you financing's getting tight. So I think if we're not there, there's one more push up, maybe from a Trump announcement, but I think we're in the twilight stages of the AI bubble popping. And if you look at the performance of the AI stocks, I think they've topped in October 31st, October 29th, something like that. It's been pretty brutal.
Do you feel that I did, as I've started to feel several months ago, that Trump's pump and dump strategy and promotion of policies which don't really bear any fruit, especially in the arena of tariffs, AI, power, etc., people have just started to tune him out and finally, thank God, started to look at the numbers.
Yeah, so let's talk about the all the deals, 21 trillion in deals. Here's the problem with that. That's promises, and it's not exactly being built anytime soon. It takes time for that money to get invested, ground broken, plants built. Logistically, you need to hire people, get blueprints. So this is way off in the future. It's not. He said, "Oh, we'll get 21 trillion coming in by the end of the year." That used to move the markets. The markets are not moving on that kind of nonsense anymore because the valuations got stretched as they always do, and they don't react. Then today I saw the taco trade today was, I saw Nvidia pop on it as it was selling off this morning. It went up on, we're gonna maybe let China purchase the H100s or whatever the hell they are, and that kind of maniacal focus on what the stocks are doing. Someone somewhere in the Trump administration has a desk set up and is looking at these stocks, and someone somewhere creates leaks and news at just the right time. This is not just like coincidence, and it's kind of scary when the White House is leaking information to keep stocks from falling. That's people really ought to step back and ask yourself, does that really is that a really healthy market? No, it's not.
So this boy, you just walked into my wheelhouse because one of my personal jihads, for lack of a better phrase, is the speculation by retail into garbage stocks. And I've just made notation after blog entry about how these garbage penny stocks are going insane. This past week, we had a stock that was a biotech company. No one's ever heard of it, Leap Therapeutics. They changed their name due to a Winklevoss investment in the company, went from becoming a biotech company to cypherpunk technologies because they're going to focus on accumulating Zcash. It had a 550% increase in one day, a one-day advance day before yesterday of 368%, and increased to a price of $205 per share on a $1.61 increase. I think that this is going to be one of those situations where the younger retail crowd, and by younger, I'm talking under 30 because I'm old and I'm bitter and I've been through a lot of these cycles, they don't really have a concept of what real pain and a correction feels like, nor not having the backing of daddy government to bail them out. Is that not going to make this not only different from an investing perspective, but from a societal perspective? To lose 90% of your valuation playing the garbage.
And the garbage will go down so fast it'll make your head spin. I was at DLJ 97 through 99. I was an electric utility analyst. And, all my brethren in the equity research department, we were right out of business school or undergrad. We had a little bit of money. Everyone was killing it in these little .com stocks, and they felt like geniuses. And then when they collapsed, everyone went quiet and they lost 80% of their money, sometimes 100%. And that kind of scarred a bunch of people. The problem this time is there's a lot of Gen Z folks playing this who don't have jobs, and they're speculating. And when this gets wiped out, they're going to be devastated because they have, at least my friends back then had jobs. They lost some money. They'd taken their $10,000 PA up to 150, and then it quickly went back down to 5. But they still had a job. I don't know what the psychological scarring is going to be from a lot of these crypto bros and these Robinhood folks that, will go out, work a job, accumulate 10 grand and turn it into 150 grand pretty quick, and then it goes to zero. It's going to be psychologically devastating.
It's going to be a bloodbath because I don't think people understand the credit markets, as you stated so aptly that if we suddenly see a 2 handle on the 10-year, I think equities are down 20% plus hard, if not more.
Yeah, look, people ask me, what is the stock market going to go down? I don't know, and I don't know how fast. I don't know if there's going to be a crash. There was, in 2000 dot-com bubble, it was a relentless 2-year bear market where the S&P went down 50%, and it was a brutal 2 years. I remember people every day come in, their stocks were red, they didn't know what to do, and that we were on the buy side managing other people's money, and it was a brutal 2 years. There were these very, very sharp counter trend rallies where people got excited, but typically speaking, most people were very defensively positioned when these counter trend rallies came. They chased the top only to have the sell off roll over again. So people were destroying value all the way down, thinking that the turn was in. In the great financial crisis, that was a much quicker sell off. I don't know how low we're going to go. It depends on what the Fed does and what the fiscal stimulus is, but let's say 30 to 50% is a good ballpark figure.
I'm a Fibonacci guy, so maybe I'm not the optimist, but I think we hit the 67, but that's me. So, I honestly believe, though, that what we're going to witness here is something that's unprecedented, because at the same time, the panic will be into government credit and secure credit and into, as we've seen, gold, hard assets that have some valuation. When you think about that from the perspective of the youth, they've been taught the digital world is the future, and they will lose a lot of hope. When you parallel that to what's going on now, it looks a lot like, for market behavior, that November, December 2018 period where liquidity was exiting the market and the banks were all warning, hey, we're having problems, you better do something. Is the Fed even relevant in this discussion, as Powell is nothing more than a lame duck heading into the last meeting of 2025?
I think the danger of a liquidity event is quite high, given that vacuum. The other thing that people should know, I've been talking to some family office folks. There was a conference recently. Family offices are starting to wake up, and they are seeking liquidity. So that should alarm people. They're raising cash. They're exiting what they can, if it's liquid, and that's beginning. So that's a whole cadre of money that's kind of woken up all of a sudden, and they're getting nervous. There was one story that was relayed to me. Some family office from Europe was here in the U.S. at this conference and said the family offices in Europe are preparing for war, and the U.S. family offices were kind of, what are you talking about? So I don't think people understand what's going on in Europe. They have a pension problem, and there it seems to, if you follow the news, they're gearing towards war, a continental war with Russia, to kind of, I guess, try to paper over the defaults that are coming.
That would be a very short war.
I think so.
Russia, despite all of the misinterpretations of their society and their military, is an extremely capable military at this point in time. And the alliance with China would be something I think that Europe would regret for decades to come, because despite China's weakened economic position, they still hold a lot of the credit strings to the Western world.
They have a tremendous amount of the world's money supply, and and there's a lot of capital controls, and it's trapped. A lot of it's trapped in corporations, banks, and rich individuals. But there will be a constant bid for real hard assets from the Chinese folks for years to come, because they are in a death spiral where they're going to be depreciating their yuan to the tune of about 10% a year. So they will be hunting for assets abroad, which is Chinese soft power. And Europe, if Europe is distracted by war and the economic collapse, the Chinese will come in and start buying up lots of assets.
Absolutely, and I don't think Europe can go to war without the United States. I just don't see Trump putting his legacy, his ego, nor world peace at risk with such a foolish conflict. with that in mind,
whether we go to
I'm sorry, go ahead.
whether we go to war or not in Europe, the point I wanted to make is that capital in, family office, smart, whatever you want to call it, smart money, family office money, is starting to get concerned and is seeking safety and selling risk assets on the margin, which is never a good thing.
So basically, what the picture you're painting for me is that Europe, Poland, et cetera, they're beginning to look a lot like Argentina and the Malvinas, for those of us who are that age and remember watching that war on television in the early 80s. They're trying to create something as a distraction when in reality their economy is so poorly managed and in the garbage, it's becoming an irrelevant power on the global stage.
Yeah, Europe is going to be a flashpoint over the next 10 years. The flashpoints are China, Europe, and of course the Mideast, which that's just a morass. I won't even go into that. Those are the flashpoints. And of course, someone asked me in a podcast recently, what should we do? I said, look, if you want to be selfish and protect American citizens, you stay out of all wars and you gear up your economy to be the arms merchant and the supplier of food and stuff to these warring nations. That's cynical. It's disgusting. But if you want to survive, that's what you do.
But does that not make us vulnerable? Because if we don't, quote unquote, pick sides, our debt levels, our exposure to the global economic stage puts us at risk if one of the sides that holds a lot of our debt and I'm not just talking government debt, I'm talking corporate debt, were to lose such a war, would that not put us at risk also?
Yeah, that would put us at risk. But you can see the government right now is gearing up to make the buyers of government debt us, U.S. citizens, the banks. These stable coins are designed to fund the U.S. Trust me. People ask, who's going to buy our debt if these foreigners won't? The answer is us. There will be financial repression, and the equity markets will be sacrificed to keep the wheels of government going. Trust me, the government will sacrifice the stock market if there's an existential problem.
You've been in this game for a long time and seen this, and there was a great individual named Charles Kirby, as far as internet personalities and investment writers, who wrote an article called Pirates of the Caribbean, where he was highlighting how the branches of the large money center banks were using shell companies in the Caymans and other Caribbean islands to buy our debt, with that practice expanding and multiplying since the 2005 time when he wrote that article. Is it not terrifying to think that we're printing money, selling to ourselves, and trying to pawn it off through third parties still at this late date, that there's not enough demand for our debt to keep this on the current trajectory, especially considering Besant's plan to go with longer term debt, which would have been great if they had done it before the tariffs, is now looking pretty dead in the water?
Well, if we get a really bone-crushing recession and there's this panic out of risk assets into U.S. government bonds and the 10-year goes to a two-handle, trust me, Besant will start terming that out as fast as he can. If there's a global liquidity crisis, there'll be a short window where he can term it out, and then there'll be the fiscal response, the Fed response, and then they'll try to reinflate it. But there'll be this short window, maybe 6 to 18 months, where yields will drop precipitously because of the panic, and that's when he should term out as much as he can.
Which do you think will happen first? I'm asking on behalf of my housing friend, Mr. Ulysses Awesome, who's in the audience tonight. If we got to a two-handle, and I'm saying 2.9, whatever, for a brief period of time, even though that would reduce mortgage rates, it's going to take sustained deflationary pressure to actually bring housing back into a reasonable level for the entry-level home buyer. Yet incomes in a deflationary scenario won't keep pace. Is it not the great trap where to get what we need, we have to wipe out part of a generation?
Yeah, that's the pickle we're in. And anything the Fed does, usually there's a monetary transmission delay. on average 18 months. If you look at the unprecedented inflation that came after the COVID printing, mind you, under Trump, people need to remember the tremendous amount of dollars printed and then spent. There has to be there needs to be a transmission mechanism. They printed and then the U.S. government spent it. That took about 18 months to start showing up in runaway inflation. Same will be on deflation. Anything the Fed does will take, a minimum of 18 months to 24 months to start to turn the tide in any kind of housing recovery. Now that'll depend on how bad the jobless situation is and where we are in 24 months out. And I can't tell you what's going to happen that far out, but what I can tell you is that home prices are going to go down. Long term, they're a good thing for the next generation, but that's also means that they have to have incomes to then purchase homes. So therein lies kind of the problem.
Before I go to a listener's question, because you really just walked right into one of the most beautiful contrasts that I've seen. And what it is we've seen the irrelevancy of Powell in the last 3 months, especially with the numerous attacks. It's all garbage. It's nothing new. Everyone forgets how Nixon, an LBJ throwing a Fed president, the chairman up against the wall. Everyone forgets their history. That's my purpose here at MacroEdge, by the way, the history idiot. You take all that into account, and then you look at what's happening now. Is President Trump and the current regime of major banks trying to make the Fed irrelevant to shift the power away from central banking and into a cadre of large money center banks and the government?
Well, that's what the stable coins, I think, attempt is. Yes, there seems to be this to make the Fed irrelevant, but be careful what you ask for. This is the system we have, and what they replace it with will not be well understood, and the transmission mechanisms may not work. Not that the Fed transmission mechanisms work all that great, because the velocity of money started collapsing in 2000, and therein lies one of the things that central bankers with their CBDCs want to get control over, is the velocity of money. That's one of those things that they can't control, and a lot of it's driven by demographics. They want ultimately to be able to give you money in your bank account, but tell you need to spend it in the next month or it disappears. So the idea of savings becomes moot for the average person.
Unless you buy gold.
Unless you
or
buy
silver.
Gold, right?
I know, I'm old. I'm reflecting an ancient ideology. We also sat there and believed in big cars with steel. Moving on to the last central bank question, we're going to pivot to the other side of the world. Right now, the Bank of Japan is in the largest quandary I've ever seen since the collapse in the late 80s, early 90s. In your opinion, does the Bank of Japan fail in their efforts to support the yen, or do they have to fail and promote the inflation just to keep their economy alive and service their debt?
Yeah. So years ago, someone asked me, when does the sovereign debt bubble collapse? And I said, it will ultimately collapse when some central bank gets into trouble, because the release mechanism for all this debt is currency at some point. And the Bank of Japan is in a demographic disaster. They have a Hobbesian choice here, where they can try to curb the inflation in their country and restart their economy, or support the yen carry trade. So, they are, you can say they're an independent company, but after World War II, I think they're a vassal state, and the Fed makes calls to them, and there's been a lot of central bank coordination since the Great Financial Crisis. So they're in a tough spot, and this is one of those black swan events. Can they contain what is happening? Will the market force them to defend their currency? I can't tell you. We saw a yen carry trade wobble last August in 2024, right before the presidential election, and they seem to have papered that over. But here we are, a year forward, and it's bigger, and it's more dire, and that can just blow up at any moment. And I can't predict that. That's just one of those black swan events. what we've been talking about is, the AI bubble is going to blow up at some point. The housing market's rolling over. That's a white swan event. It's just part of the cycle. But this Bank of Japan, if that goes, in the next year or two, that's just not good for any of us.
I think we see a 170 sooner than later in the end. And I believe that they're going to sell American equities versus American treasuries based on the comments you've made also that we expect price appreciation. Why would you sell a depreciating, unguaranteed, unwarranted asset when you have one in your possession and you can hold out and hope that we get QE part 19,055 or whatever number we put onto it this time, because we know the new Fed chairman is going to do whatever the president wants to try to salvage the U.S. economy.
Well, the other thing we need to talk about is, and a lot of smart economists are talking about this. We have not done overt yield curve control yet. That's one of the tools in our tool shed that may come out. That Japan engaged in that for decades successfully, and that's why I'm so bullish on long bonds and the 10 years. That we have the U.S. government wanting to get those rates lower. We have the economy going south. Lower growth will cause a sell in risk assets and a panic into safety. So we still have yield curve control in our tool shed that we haven't used yet, at least overtly.
Well, I don't want to abuse our time with you, but I've got two questions to close out the show tonight, and then we'll have the big question, as I always like to spring on everyone, because I believe in freewheeling discussion, and you have been fantastic as a guest, Ed. I really appreciate your time tonight, and this has been one of the more fascinating discussions that our listeners have had a chance to enjoy, because we're presenting different alternatives to the mainstream. That's why you don't hear these discussions on financial television, because it scares the hell out of their viewers. So Wes is asking regarding your deflationary comments. I want to believe this, but would you say population centers of the world will fight deflation just due to competition? I'm saying the places that people want to live, it feels like an endless treadmill. It's an interesting question, but I don't know if that's going to sit there and hold up against market forces. Your opinion, please.
So I'm not sure I understand the question. The question is, people will flee to certain regions, and that will cause
to fight deflation. Yeah, to fight the deflationary impulse.
This is such a huge demographic global problem. I just think it's going to be hard to avoid the cycle. There may be pockets of it, and if you find it, let me know. I'll join you. But this is decades of leverage upon leverage upon leverage and financialization of the U.S. economy, and I think it's unavoidable at this point, and unfortunately, I think it's closer than I'd like to think, because the midterms are coming up, and it just seems like the market would love to give up the ghost right before Trump's midterms. It seems like there might be some forces out there that would love to see that.
With that being said, and this is part of the giving up the ghost theory, absolutely 110% agree with you on this. Would you not agree that there's a greater benefit to rolling into short-term treasuries for yield, if that's what you're searching, versus price? And they're going to let short-term yields rise versus long-term yields in an attempt to sit there and re-stimulate long-term credit in the U.S. economy.
Say that again. So you're saying that you'd favor going to short-term paper?
Which I have. Open disclosure, I've been in it for a while as part of my hedge for this period, because I think that short-term paper, they're going to let it slip yield-wise back up over 4.5-5% in exchange for lower long-term yields and cycle the paper out, because China is staying in short-term paper. They're not buying long-term. They're just rolling it over the long-term into short-term debt. Logically speaking, you want to force them back into that long-term debt as Bissett wants.
Yeah, well, if the Fed is behind the curve, like I believe, and they do emergency rate cuts sometime in the future, in the next 6 to 12 months, and short-term paper will get a bid, I mean, look, if you're risk averse and you just want dry powder to go back into the market at better prices, I've been telling most people to just buy T-bills and government money market funds, and just kind of and I don't I don't tell them, hey, go 100%. I say whatever you're comfortable with, whatever amount of dry powder you want. And if you're younger, smaller amounts of dry powder. If you're 70, you want to be very light equities in short-term paper.
Guilty as charged. I'm in my 60s, so what can I say? So let's go to the big question. Of all of the events that are on the horizon, the midterms are approaching, and I'm not drawing a direct apples to apple comparison, but this feels more like a Hooverian 1930 midterm election where policy mistakes on top of financial mistakes, on top of a tariff trade war, which is absurd at every level, has created so much market and political instability, not just on a US scale, but on a global scale. Someone is going to have to come to Trump and straighten him out. But if they fail, he could lose people like Phinance who just bail out for quote unquote health reasons or whatever. And the Fed becomes his toy, etc. Is not the risk the instability factor heading into the next 8 to 12 months and people totally on the wrong side of that trade believing that equities would recover?
Yeah, this is a huge problem. Trump's messaging has been an abomination. The gaslighting is just as bad as the Biden administration, and they seem to think for some reason they can avoid the valley that's coming. And the valley was set up from the Biden administration because the last 2 years of that administration was goosed by government spending and illegal immigration, massive government payroll hires and illegal immigrants and NGOs being funded to bring these people in. That was a huge ecosystem unto itself that really put a floor under the economy for a while. Again, the reason why Trump won is because the average person was not seeing anything, and real wage growth was minus 2% coming into the election. Now Trump is in, and now he's claiming victory and claiming the economy's great. And unfortunately, real wage growth stinks and jobs are going the wrong way. He is going to be, if he doesn't change his messaging and try to have fireside chats and signal what happened under the prior administration and what his plans are to eventually bring us out of it without any, it won't be near-term impacts, it'll be a long-term slog. He's going to be labeled the next Hoover for sure, unless there's a miracle and they change messaging and policies. 50-year mortgages are not going to cut it.
50-year mortgages won't work as the math doesn't math. Then again, as you have observed, and many of us have observed, for this current era, math is hard. Sir, please promote your website, your Substack, and everything else once again. And thank you so much for joining us here tonight.
Yep. My personal website is eddowd.com. My firm website is financetechnologies.com with a PH. I'm also found on X at Dowd Edward, and those of you listening know that already, but in case you don't know. I get requests for a lot of podcasts. I can't do as many as I would like, but I try to stagger them because the economy doesn't really change every day. So, if you don't see me for a couple of weeks, it's because, there's nothing to talk about. I don't like to just talk to talk. So, but when there's stuff to talk about, I'll be out there.
And there's always something to write about, as you and I have discovered. Heck, who knows? We may find another biotech firm that becomes the next great crypto bank. I couldn't believe that when I read it myself, to be honest. MacroEdge.net/ozone, MacroEdge.net/ozone. Go to our YouTube channel. Watch all of these great interviews that we've had. We've had so many fantastic guests. We have more coming in the future, including some potential surprises. Ed was a surprise. It was great to have him on. Mr. Dowd, please don't be a stranger and join us again.
Thanks a lot. Great to be here and had a lot of fun. Thank you.
Thank you, sir.